an indexed annuity with a guaranteed income rider. When you add that guaranteed income rider to this contract, you're essentially creating two values that are independent in most cases from one another within that one contract. So the way that I break it down is relating it to a T-chart. So if you are taking notes, go ahead and draw a T-chart out on a piece of paper. And I have a whiteboard exercise that I've used in a previous Zoom meeting with our clients, which I'll share here as well for you to look at. And please forgive me because it does look like a kindergartner wrote it. I was using my mouse to draw it out. So hopefully you can still read what it says. But when you think of a income rider being added to this annuity contract, you're essentially creating two different values within the policy that are tracked and regarded as independent from one another in most cases. On the left-hand side of this T-chart, you have what's called the account value. And the account value is essentially your initial premium investment plus any interest earned on a non-guaranteed basis. Okay, on a non-guaranteed basis. On this account value, you do have a guarantee of principal protection. So remember the word annuity, I often ask our audience to refer to that word annuity as guarantee. And it just comes down to what type of guarantee are we getting in the specific annuity type that we're interested in. And in this case, you're getting two different guarantees when you add on this income rider. The first guarantee is on your principal protection, which is going to apply to this account value side on the left-hand side of this T-chart. So your principal's protected. That initial premium investment can be allocated to a number of different index crediting strategies that are offered within the contract. And just know that your money is protected. It's not directly invested in the market. It actually just sits off on the sideline, but there are indexes that are used to gauge the performance and how that interest may be earned over time. We do say that that interest is earned on a non-guaranteed basis because there's no guarantee of those indexes performing, no different than your 401k or your stock account. We don't know what they're going to do day to day or year to year. That's no different in the indexed annuity. But the guarantee does happen to fall around the principal protection, which there is no downside risk in the event those associated indexes were to perform negatively in any given crediting period. On the right-hand side of your T-chart, that is where this income rider is coming into play. So you're going to have this income benefit account, essentially, that is where another guarantee is being bolted on to this contract. And this guarantee is centered around how that initial premium investment grows on a guaranteed basis over time. Oftentimes, when people purchase indexed annuities with guaranteed lifetime income riders, they're planning to defer that money for a period of time. So some scenarios are, maybe a 60-year-old person that's still working. They plan to retire at 65, but they want to shield that asset from volatility in the market and give themselves some peace of mind, clarity, and confidence that their income is going to grow on a guaranteed basis and essentially creating or eliminating rather the uncontrollables of the market. So the income rider gives a guaranteed rate of return or growth on that initial premium investment. And it's very powerful because that person knows exactly how much that income will be at the time they go to retire. And it's a great way to eliminate the sequence of returns risk or unfavorable sequence of returns in the markets. Now, some of the income rider contracts that we're seeing today, being an independent annuity advisory company here at Annuity Association, we scour the entire marketplace and look at the most competitive offers that we can find for our clients. And on these income rider roll-up rates, which is what they define as the rate of interest that's being applied to that initial premium, we're seeing those anywhere from 7 to 8% in most cases. But what I will tell you is don't get so caught up on what the actual roll-up rate is. And I'll explain what I mean by that later on in this video. But there are going to be a lot of terms that you hear a lot of words and different fancy buzzwords, if you will, that are going to be used and positioned to you by agents and advisors. But those buzzwords don't mean anything. What matters most is what is the bottom line? Who is going to pay you the most amount of guaranteed income at the time they state they'll pay it? So if you're planning to defer 5 years, and that, as I gave in that example, what matters is who's going to pay you the highest amount. It doesn't matter what the roll-up rate is necessarily. There are many factors that go into determining that guaranteed income amount, but in this exercise, the key is to understand that the income benefit value on the right-hand side of this T chart is going to grow at a guaranteed rate each year of deferral. But that's only one of the many factors that goes into the formula to determine the highest guaranteed lifetime payment. Some additional things to note there on the income benefit side of this T chart is going to be that in some income rider contracts, they will offer a bonus. Now, this bonus will, be applied to this income benefit value, but any money that's growing in this income benefit value column is never withdrawable as a lump sum. It's only used to calculate the lifetime payment. So, let's say you go into that scenario where you're deferring it for 5 years and then you change your mind and you don't need the income any longer. Maybe you had a different goal now for this money. That income benefit is not withdrawable as a lump sum. The only money that would be accessible to withdrawal or surrender would be the account value side on the left-hand side of that T chart. But on that income benefit, it's going to grow based on the roll-up rate. So in this example, I'm showing an 8% roll-up rate, growing that $100,000 on a deferred basis. And then some other ways that that income benefit can grow on a guaranteed basis is, again, by offering that bonus. So, you'll see bonuses sometimes 20%. I know there was a carrier towards the end of last year that was offering a 51% income benefit based bonus. It's all fluff, honestly. We're here to bring you the facts. We're here to be authentic in the way that we look at these products. And that is, we're looking for the facts. What is it that is going to really contribute to the bottom line? And while a bonus is on paper growing this income benefit account, what matters is the final bottom line, and that's the guaranteed income. I keep alluding to that. And the other factor that goes into determining the overall guaranteed income would be the income benefit base amount. So whatever that's grown to on a guaranteed basis after the bonus and after the roll-up rate's been applied each year. The last factor that goes in is what's called the payout percentage, or the withdrawal rate, or the payout rate. So they all refer to it as different things, but it's essentially a percentage of the total income benefit value. When you multiply those two numbers together, that'll equal the guaranteed payment. That payout rate or payout factor can be based on single life. It can also be based on joint life. Obviously, if it's joint life, it's going to be covering 2 lives. So it's going to pay a little bit less than the single life payout factor would. But that payout rate, nonetheless, is also guaranteed in the contract. So that's important to note. When you buy an annuity like this and you receive that policy in the mail, in that contract, when you go over it with your advisor, they should be showing you all of the terms and conditions, all of the account summary, as well as the income benefit rider page or specification page, which will show you the bonus, the roll-up rate, the annual fee for that rider, etc. And they should be showing you, last but not least, the payout schedule, which has all of the payout factors based on the age at the time of income election. So if it's for a single person, it would be the age of that single person that it's covering at the time of income election. Or if it's joint, there'll be a joint schedule, which will show the age of the younger of the 2 annuitants on the contract and what that payout rate will be for the younger of those 2 annuitants. So it's very important. What we do for our clients is I'll highlight those things in the contract before it's mailed. That way we know exactly what to look for. The other thing to note is that these income rider contracts, they're flexible. So even though you might be deferring it for 5 years or more, if your needs change and you need the income sooner, you can activate the income at any time. In most cases, either right out of the gate. Sometimes they'll have a 1-year waiting period. But either way, you can activate it at any time you see fit. Obviously, though, keeping in mind that the income may be a little less because you didn't defer it as long and it didn't get that extra roll-up rate that it would have gotten if you continued to defer it. Shifting back over to this account value side on the left. So that is your premium investment. Sometimes they do offer a bonus over there that's called a premium bonus. But in one case or another, either it's going to have a bonus or not. But where this account value and the purpose of it is really to be looked at as your liquidity account. So this is your walk away money. If at any point in time you have a change of heart and you decide to forego that income benefit and just want to cash out, you can do that. And the money that you'll receive will be whatever's in this account value column minus any surrender charges that may be incurred if you're still within that surrender period. The surrender periods in these contracts are generally 7 to 10 years. So if you're in that 7 or 10-year window, there will most likely be a surrender charge that's incurred on that full withdrawal in the event you decide to surrender. You do also have some liquidity during that surrender charge period in the event you need a little bit of money to come out for maybe an unexpected cost of some sort. In most of these contracts, you're going to be able to get at least 10% or sometimes more, depending on the product. But most of them are 10% free withdrawal per year to help service any type of liquidity needs that you may have. And then last but not least, this account value can also be represented by your death benefit. In the event that you pass away and there's still money left in this account value at any point in time, whatever's left in that account value will pass on to your designated beneficiaries in the contract. That's one of the biggest misconceptions of these types of annuities, is that if you pass away, the insurance company keeps your money. That's entirely false. That only occurs in one type of annuity structured in one particular way, but that is not this type of annuity. So this is your death benefit. And then last but not least, remember that this account value still has the ability to earn interest on a non-guaranteed basis according to the various index crediting strategies that you may be allocated to. So in a perfect scenario, in the right annuity with solid index crediting potential, that account value can sometimes grow over the deferral period, and most likely will in a lot of cases if you're working with the right annuity. And it can also sustain that account value by the indexed interest that's coming in that can offset the income distributions when they go out. So, think of it like a checking account. If you were to put money in a checking account and then take an annual withdrawal or a monthly withdrawal to service your income needs, the balance of that checking account is going to reduce every time you take a withdrawal. In an annuity, it works the same way. When you take a withdrawal using the lifetime income rider, that withdrawal is deducted out of your account value. But since it has the ability to earn interest from the index crediting strategies, in a perfect scenario, you can find a good annuity with great index potential, and those index returns can help offset the distribution that you're taking through income. So in a perfect scenario, that account value can sustain itself longer so that you can have higher potential for